Alright, we are back for part 6. So we've talked about all the entry criteria. We've talked about the exit criteria. We've talked about how to automate profit taking so that you can be away from your computer and the profits will still be taken if the market hits your cover order. We've pretty much covered everything that needs to be covered for the actual trade of a standard Iron Condor. Now, what other types of Iron Condors are there? There are there's quite a few differentiating things you can do. You can do the main alternatives, I should say, to this standard balanced Iron Condor would be a directionally skewed Iron Condor or a unbalanced Iron Condor. So what do I mean, first of all, by balanced? I mean balanced because both the put spread side, which is our 16-18 spread, and call spread side, which is our 21-23 call spread, are 2 points strike differential. So the difference between the strikes is 2. So we have the 21 call, the 23 call, 21 minus 23 is 2. We have the 18-16 call, 18 minus 16 is 2. So both are 2 points wide, or you can say both have a 2-point strike differential, or you can say the width of the strikes is 2 points, or you can say the width of the spread is 2 points. There's a lot of different ways that different people say that number. So that's balanced. Both sides are both 2. What is unbalanced? Well, your intuition is probably already telling you that that's simply when one side is a different width than the other side. So one side has a different strike differential than the other side. One side has a different width of spread than the other side. One side has a different strike width than the other side. However you want to say it. It all means the same thing. So what if we were to change? So how would we make this unbalanced? One really simple thing would just be to say 21-24. Now, to give you a really accurate representation of how this changes the spread, we're going to have to make some changes to the actual spread itself, since this initial December spread has now decayed so much. So let's keep that on the screen and build a new one in January. So let's see here. Let's pull open the Jan 15s. We've got 42 days until expiration, so it meets our duration criteria. And we've got 14 strikes showing. The closest to 30% roughly. We'll go with the 17s, which is close to 30% probably in the money for as far as what we're going to sell on the put side. And let's just stick with 2 wide, go to 15, and then let's look for 30% on the call strike. So we're going to be selling the 20, and we'll stick with 2 wide here and go to 22. So you can see if we rebuild this spread, we're above our 30% width of spread minimum. So we're still looking at a balanced spread here. But we've moved out to January. This has a nat price of 64, a mid price of 71. So we're looking at a 7-cent mid nat spread. That's not too terrible for a multi-leg, 4-leg spread like an Iron Condor. So it's a pretty liquid overall spread, as we would expect, because the liquidity in GDX options is pretty solid. The tighter this mid-nat spread, the better, of course, but 7 cents is certainly reasonable. And we're not even in open market hours, so we're not sure if this is an accurate representation of the mid-nat spread, but generally it's pretty close even after hours. So let's go ahead and play the spread. Let's carry this over. Right-click. We'll go to Analyze Trade, and we're going to uncheck our December spread. And I'm going to pull this up just a little bit so that we can expose the entire January spread. And let's center this a little better. Okay, so we're specifically focusing only on this bottom January spread, where we've sold the 20-22 call spread and we're selling the 17-15 call spread for a total credit, we'll say, of 70 cents to keep things simple. So what happens, actually I'm just going to unlock this, so it's going to go back to 71. What happens if we unbalance it? So what if we say we want to do 2 wide on the put side, 3 wide on the call side? What happens, and why would we do that? Okay, let me answer the second question first. Why would you want to do an unbalanced spread in the first place? Well, it's because you have a directional bias, and it's one way to it's not necessarily considered a directional skew, but it is somewhat of a directional skew in the sense that you're taking more risk in one direction. So you are a little more confident than, well, you're a little more confident that the stock is not going to go higher against you to the upside. So you're willing to take more risk on the upside in the way that we have it unbalanced here. So if we were to change this back to 2, and let me actually put these break-evens to 117, and let me change this probability date to reflect our actual trade here. So you can see here we currently have 52.76, so our 2 points not really going to work. But if we change the 17 to an unskewed 1714, then we would do this if we believed that we weren't going to get tested to the downside, or if we were willing to take a little bit more risk on the downside than the upside. So what does this translate to? It translates to, you can see the break-evens have gotten a little bit wider. So here was our previous break-even on the balanced, and you can see here's the one on the unbalanced on the low end, and you can see it's a little wider on the high end as well. So here's our previous one, and here's the new one. So we previously had a 52.76% probability of success. If we set our slices to break even, that's going to jump up just a touch to 53.78. So you got a little bit of a bump there. We're almost at our 55 minimum, not quite. So in this case, essentially, if you take your cursor and go to the max loss, you can see your max loss. Your credit moves up to 77 cents here. Your max loss on the downside is $223. So on the downside, you're risking $223 to make whatever your profit objective is. But if we're looking at this from a max gain perspective, 77. So if we were to take 50% of 77, that could be your profit objective. And then on the upside, we're only risking 123. So we're risking, $100 more on the downside. Now, why would you want to do that? Well, if we set slices to chart, you can see here, I could probably make an argument to why I would personally be willing to risk a little more capital on the downside, because we've got multi-year lows here. We've seen some nice support right around these levels. We've seen some nice support in the 18 area. Right now it's dipping back a little bit, but if it's to get all the way back down to this previous multi-year low, I'm thinking there might be some buyers to come back into the equation. I'm at least thinking to myself that I'm willing to risk a little more capital, that we're going to get, some buyers will come in if it does happen to retest this area. Versus on the upside, there's potential for it to easily get back up to, maybe 24, 25, 26, who knows. But, so that would be a reason in this particular example that maybe I'd be willing to risk a little bit more on the downside. So another alternative to an Iron Condor versus this unbalanced would be a directionally skewed Iron Condor. So what does that mean? Well, currently we've got our, let's change the break-evens back. So we're back to the initial one that we built in January. Our 2-point wide balanced with no directional skew. And how do we know it has no directional skew? Well, both the short strikes we picked were right around 30% probability in the money. And you can kind of also look at these these outer percentages. So our probability on the low end is, of losing money on a downside move is 22.36. Probability of losing money on an upside move going out of our range is 24.89. So those numbers are pretty close to each other. There's no real major directional skew. Well, how would we skew this directionally if we were to be willing to skew it directionally? Well, you'd want to skew it to the side that you think there's more risk. So if we're going back to this chart, and I just kind of explained, I think there's less risk of any real major, push below this previous lows, and maybe there's more risk of some big recovery in GDX. That's just my personal opinion. We're just kind of looking at theory here. We're not, this isn't an actual trade that we're making. So with that in mind, I would want to skew it to the upside. So I would move my short strike higher on the call side, move that to 21, and if I'm keeping it balanced, I move the long strike to 23. So what does that do? Well, it reduces our credit fairly significantly to 55, and it also widens our range pretty well. So if we change our break-evens, you can see our probability of success has gone up to 57.87, And if we set slices to chart, you're going to see that our break even is significantly higher. So we've got a lot more room for a little bit of run to the upside, and it just gives us a little bit more cushion to the upside. And so if you have a little bit of a bias, then you can push it to the upside. So there's one example of directional skew. Another example, and this is an example of skewing directionally and accepting a minimum acceptable credit just below our 30%, because this credit would be 55 cents, which is 5 cents under our 60%. So we're getting a wide range here. But what if you say to yourself, you know what, I'm just going to keep the tighter range that we had in our original one, but I'm going to move the whole spread with a little more cushion to the upside. So to do that, you would just simply move your puts higher. So you go 1 point higher on your put, your short put, 1 point higher on your long put. Now you've got the same width there, and you can see if we move our break evens, we have a lower probability of success. So we've decreased our probability of success because we have a specific directional, a specific balanced directional bias here. As far when I say balance, I mean we have the same width. So essentially we just move the entire spread over a little bit. So let me just kind of backtrack just for a second. So our original spread, we had the 20, 22 on the calls, and we had the 17, 15 on the puts. And if we set slices to break even, we have a 52.75 probability of success. We've got 22 on the low end, we've got 24 on the high end, and we're pretty much, we've got let's see, between our two short strikes, we've got a 20 short strike and a 17 short strike. So we've got 3 points in between our short strike. All right. So if we just move the entire spread, and let's just put this on this chart real quick. So here it is on the chart. We've got plenty of cushion down here on the bottom end, and quite a bit of risk here on the high end. So if we go back to the Analyze tab, and we say we just want to slide this thing up and skew it directionally to the to an upside move, then we want to keep the width between the short strikes at 3. Whereas in the first directional skew, we moved it out to 4. We didn't touch the put spread, we just moved the call spread higher. So that moved the width between the short strikes to 4. But we want to keep the width to 3, so we're just going to move the entire Iron Condor, slide it up. So here we go. We're going to change the calls to 21, short call to 21, long call to 23, short put to 18. So here's our first one. Now we have 4 points between the short strike. We have a short 17 put, and we have a short 21 call. So 4 points between our short strikes. But we're keeping this at a 3 point. So we're just sliding it up. So we change our 18 put, our 17 put to 18, 15 put to 16. Now we still have 3 points between our short strikes. We've just slid this whole puppy up. And this is another way that you can directionally skew. So what does this look like? Well, let's get a refresh. Here's what the initial one looked like on the chart. Here's where our initial one was. And if we go and set slices to chart, it's going to override that one, which is why I wanted to show it to you real quick. And you can see we've moved up a bit on our lower break even, and we moved up a bit on our upper break even. Well, if you say to yourself, you know what, I'm still comfortable with taking a little more risk on the downside, and I still want a little more room on the upside, and I still want to keep my short strike width 3, you can just move the whole thing up again and go to 22 on the short call, 24 on the long call, 19 on the short put, and 17 on the long put. And here we go. Let's set slices to break even. You can see we just slid the whole puppy up again. And it's getting higher and higher. And if we go to set slices to break, or set slices to chart, you'll see we've got even more risk on the downside here. So none of this stuff down here is within our break even anymore. But we have a ton of empty space up here. So this is a very bullishly skewed Iron Condor in this particular example. I don't tend to really do things that are quite this bullish or directionally biased. I tend to just stick with the original one that we did, which is pretty balanced on both sides, and doesn't have a directional skew. So I tend to do balanced iron condors with no real directional skew, which may be boring, but that's the way I tend to win. What you can see here is we've gone down to 45%, and you have to kind of throw some of the criteria, or be a little more lenient on some of the criteria. So you can see this is a lower probability of success trade. It's below 50, which I hate going below 50%. But most importantly, our downside risk, we've got 44.74, where before it was like 22, 23. And on the upside, it's only 10, where before it was around 24, 25. So this is very, very skewed towards having a directional bias towards the upside, you know. So you really are thinking that this stock is not going to go much lower, and that all the risk is to the upside, so you want to give yourself much more cushion on the upside in this particular example. So that's pretty much your directionally skewed. So the few types you can do are the standard iron condor that we discussed throughout the entire first portion of the video, and that's keeping the widths of the spread the same. You know, in this case we had 2 on both the put side and the call side, and that's keeping your directional bias pretty much out of it, just being really even, kind of centralized. And then you can do unbalanced, which is where you have 2 different strike widths on the put and call spread. So one side might be 2, one side might be 4 or 5, one side might be 5, one side might be 7, one side might be 10, one side might be 12, whatever. Depends on the situation, but I think you get the point. And then lastly, we talked about some directional skew options where you can skew, you can slide one side up, or you can slide one side down. You know, slide the put side lower, or slide the call side higher, and keeping one of the other sides exactly where it is. Or you can slide both sides higher, or slide both sides lower if you want to keep the entire spread, the short strike distance or width the same. The last thing you can do really is go extremely wide on iron condors as far as the width between the spreads, and you can really only do that in really high priced stocks. So if we were looking at something like Priceline, that's $1,135. It's not a good candidate right now with the IV percentile at 7, but I'll just kind of give you a quick idea of what I'm referring to here. Let's change our strikes to all, and you can say, based on that 30%, I'm going to go with the 1095 short put, and let's say we want to do like a 100-point wide. Oops. Go all the way down here to 995. What's going on here? So we're doing the 1095. There we go. 1095. There we go. And so you do 100 wide. So then we sell the 995. And then we go and we look for the 30% on the call side. We're way past it. There we go. So we're at 1175. So we're going to sell the 1175 and then buy the 1275. So now we have a 100-point width between the strikes on both sides. So I mean, there's just another thing you can do. Really extremely wide distances between your strikes, and you can see what that is going to translate to is you have the opportunity to make 2,600 per spread here, and you're risking 7,400. So it's a totally different ball game at these levels. But it's an option on the table. I just wanted to make sure I showed you. So that's going to be it for our different varieties of iron condors. There are some other things and creative things you can do out there, but I mean, this is pretty much your general wheelhouse that you're going to be sticking in. And like I said, let me just reiterate, I tend to stick with balanced and with no directional bias, just kind of keeping it even on from a directional perspective. But I do occasionally do some directional skew, and I do occasionally do unbalanced. Just the majority of the time, I keep it simple and keep it balanced and keep with no directional skew.